Inflation data continues to cool and the Fed has a cooler response. I'll give those updates and implications on the market. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, this week, it's been a big week in the economy, and the markets have responded. We'll get into what the potential implications are. We're going to start with inflation, right? That is the big story. This is the universal tax that we all pay. This is the number one problem, okay, that needs to be addressed in the economy by the Fed and so on. And we got good news on Tuesday earlier this week that inflation CPI data came out for November, and it came in, of course, cooler, not of course, right? That could have been a shocker on the upside, but inflation's a rate of change number. And so we don't need prices to go back to where they were for inflation to go away. We just need inflation to not be accelerating as quickly. And 1 year ago right now, inflation was really starting to ramp up. And right now it feels like we're on the downslope where maybe, prices aren't, it's not deflationary like we're seeing at the gas pump, which is great news, but they're definitely increasing at a slower rate, okay? Very easy for me to say. Inflation came in for November year over year, 7.1%. That beat expectations just a little bit. That's great news, but overall it does show inflation appears to have peaked and we're on the downdraft, okay? So take a look at this chart where inflation peaked about the midpoint of the year above 9%, and that's by the CPI. We all know inflation really has been, over 10%. It's been in the double digits. If in fact inflation has peaked in the summer and is sort of going downhill from here, hopefully that's good news, and we'll continue to see inflation then get lower and lower in the months to come. It's very possible, guys, that we look back at all of 2022 and we get the data a month from now, and inflation for the entire year might be in the 6%, 6.9, 6.8% range. That would be good news. By the midpoint of the year, I would have said it's going to be 10% for 2022. May not be that way, so that's great. The big news is if inflation has peaked and is coming down, then that suggests the Fed doesn't need to be as aggressive in their tightening of their monetary policy. So we then get the news on yesterday, that the Fed, instead of raising interest rates, the Fed funds rate, by another 0.75%, they cooled off. And instead of raising by 0.75, they only raised by 0.5%. That's been sort of the kind of prevailing expectation. I surveyed our financial advisors in the morning on Wednesday or around lunchtime, and that's what we were all thinking. We were expecting then that Wall Street would like that news, and I think it did for a moment. But then the Fed chairman continued to say, well, listen, there are sort of two things that were warning signs, okay? And this is where we'll kind of lean in. And one is interest rates might stay higher for longer, is one of the things that I believed, caused Wall Street to respond negatively and push the market lower following the announcement. And that is, listen, inflation isn't going to go away quietly, and we might need to keep interest rates at an elevated level for a longer period of time. So that's one. But number two is the realization that the economy may be slowing and is slowing here. And Wall Street's then grappling with, well, what could this mean? Yes, it's great that the Fed isn't raising rates as aggressively, but what does this mean for the overall economy? So we all need to hang on what the Fed says, but let's just not overlook the fact that in 2020, the Fed said at that time, now this is after we were rebounding and all of that sort of stuff, the Fed, Jerome Powell actually said, we're not thinking about raising interest rates, and we're not planning on doing that until at least 2023. Guys, and here we are where we've had, unbelievable inflation and the fastest rate hike from the start of a rate increase period, I think ever, and the fastest rate increases since the 80s, and last time we saw inflation this high. So you can only, right, and of course, circumstances change, and so the tune changes. I get that, but at the same time, you can't take what the Fed says as gospel. All right, so with that out there, what does this mean for you, for the stock market, for the bond market? Well, listen, there has been this thought that we're going to see a soft landing and the Fed is going to start raising interest rates more slowly and then start cutting interest rates, and there will be less damage, less pain in the economy, and we'll be able to really sort of shoot the moon here and be able to calm inflation without causing a recession. Guys, that is it's very, 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 very difficult to do. In fact, when would the Fed lower interest rates? What would cause that? A recession. Them trying to spur on and spur on economic activity. That's the only time they would lower interest rates. And in order to do that, they're going to have some reason that, well, the economy is not growing fast enough, therefore we need to lower interest rates. We're not worried about inflation. Guys, that's not going to happen on its own. Likely, and again, it's not, I have no idea what the future holds, but it's very unlikely the Fed's going to be able to lower interest rates unless there's some measure of economic pain. So what are the implications? On the stock market, it's very likely the stock market doesn't like that inflation so high. That's challenging. And as interest rates go up, we've done some videos on that, how that clouds profitability for companies in the future because they've got higher borrowing costs and so on. And it's part of the overall equation of trying to calculate what a fair market value is for a company anyway, what the share price actually should be. So it complicates things. They don't like high interest rates. And then yet at the same time, obviously, stocks are going to be challenged if we do see an economic recession or some economic slowdown. And so I think the implications on Wall Street with stocks is still, it could be a challenging road ahead, a very uncertain road ahead. There's many out there that are projecting, hey, the low is in for the stock market. That was established back in October. It's nothing but blue skies from here. I hope that that's true. If that's the case, then any sort of economic slowdown or recession is going to be would need to be very, very, very mild for that to happen. I think that's possible, but unlikely. All of that, I think more volatility ahead for stocks. Therefore, make sure that you've got the right level of risk in your overall portfolio, that it's connected to your financial plan, i.e., when are you going to need this money? If you're in your late 20s, early 30s, you're not going to touch this money for a long time. You can ride through the ups and downs, okay? But if you're on the cusp of retirement, you've got to make sure that you're taking the right level of risk. Some dollars you're going to need to start drawing early in retirement. Some dollars you won't touch for, a couple decades. So you want to have the right approach. I've done lots of videos on that before. So make sure that you're taking the right level of risk. Make sure that you're using multiple strategies so that you're managing risk. You've got more diversification than a normal approach would offer. So that's kind of implication for the stock market. Now, implications for the bond market, I think this could be good news. Ultimately, we've actually had that as the growing consensus has been, listen, I think the Fed will be able to slow down how quickly they're raising rates. And as that sort of started about a month, maybe 5 weeks ago, the bond market has actually really rebounded. The 10-year Treasury note, the 10-year Treasury interest rate has declined significantly since a couple of months ago. And as interest rates go down, bond investments go up. And so yeah, the longer end of the yield curve or further out on the yield curve, gosh, that's so geeky, has actually come down a little bit, and bond investments have improved because of that. I think there's a potential for that to continue. So implications are, gosh, hopefully bond investments improve from here, and it may be worth, if you're not investing in bonds directly or in bond mutual funds, it may be worth taking a look and trying to lock in some fixed income interest rates or bond interest rates, something like that right now, because we may not see interest rates go much higher, much longer. So big implications there, and guys, obviously a lot, time will tell. Back in the late 70s, early 80s, I don't want to scare anyone. I've talked about this before, but we had sort of a double top inflation. In some metrics, you could say a triple top inflation, that it started coming back down and then it came, it went back up and then it came down and then it went back up again. Are we going to see that again? I don't know, guys. We've never printed $5 trillion and just thrown it into the economy in just a couple of months, increasing the money supply by that much. So work with your certified financial planner. Make sure that you're taking a wise approach in your finances with your investments, but also with your overall financial plan and managing risk appropriately. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us here as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.